University Module 3, Lesson 5. This lesson is about indicators. So, to begin, I will say that you do not need indicators to be a profitable trader. And in fact, many of you will be better traders without the use of indicators. Indicators can often be a crutch for people to cover up for deficiencies elsewhere in their analysis. And honestly, I'm not a big fan of over-reliance on indicators, though I will say there's no problem with using some, especially if it can add, effectiveness to your trading. So there's a reason why I've set indicators as a later lesson, because really you should be able to trade from market structure and price action alone and trade profitably before adding indicators. You don't want to tweak too much. You don't want to become somebody who essentially has shiny object syndrome by chopping and changing between many different indicators too frequently. So with that being said, I'm going to cover 6 types of indicator here, which will be volume, RSI, moving averages, VWAP, some type of bands. I'm going to talk about Bollinger Bands and VWAP bands, and then also Fibonacci retracement. So I'll also say that the main indicators I actually use are none of these. The main indicators I use are actually from a website called coinalyze.net, though there are multiple other websites like it. The website which allows you to see things like open interest, funding rates, and cumulative volume delta. But they're actually all going to be included in the 4th module as their own separate lessons, so I won't talk about those here. Today I'm going to talk purely about indicators that you can actually have on TradingView, and you can load them up on your chart. So let's get into it. Number 1, volume. All right, volume should be fairly self-explanatory to anybody who has reached this part of Scalpers University. But on TradingView, you simply go to indicators, type in volume, and add it to your chart. You can see I've already got it on the chart here. Green and red bars corresponding to down and up candles. And you can see in the top left corner here that depending on where you tab over or where you hover over, you can see the volume within that particular candle. So we're on a 15-minute chart here. And if we go to this highest volume node from today, you can see that there were 8,534 Bitcoin traded within that one candle. All right, so that means that's total volume. That doesn't indicate buying and selling. It just indicates the total number of Bitcoin that traded hands. So obviously for every buyer you have a seller and vice versa. So volume is a good guide basically to give you an idea at extremes of what is happening. It won't take us long to find an instance where volume is relevant and useful. If I go out to an hourly chart and I zoom out a little bit, you'll see that typically volume will coincide with spikes in volume, or at least increased volume will coincide with bottoms and tops. So you can see here, the volume spiked obviously on this move down and we went slightly lower. But what you notice is that we had elevated volume for an extended period within this, which marked a bottom. Again, here we had a big green volume spike from a relatively low volume period. So we were a relatively low volume here. We then had a green spike, which marked a top, and we reversed back into kind of a low volume sideways downwards consolidation. So there's not really too much more to say about volume. The thing I say with volume is to use it as a tool of confluence along with your other analysis methods. So in particular, if you're looking at low time frames, and obviously this is a scalping course, so if we're getting really into like the 1-minute chart, we're looking at proper scalping. Here's where volume, in my opinion, really comes into its own. you can see at the very bottom here, this last candle down, which pretty much marked the bottom, this last candle was a significant spike in volume. What does that actually mean? Well, if you have a sharp move down or a sharp move up, coupled with super high volume, that's telling you that a lot of people are selling if it's going down. A lot of people are selling and probably being forced to sell. You can tell that by the combination of price action, the way it's moving down with no bounces, and the high volume, the spike in volume. So you can tell that some people are being forced to sell. So they're either getting stopped out or they're panicking and selling. And often where the point at which volume is the highest is what marks a bottom. Okay. Typically you'll see something like this where you have a large spike, and you may see something like in here it was quite clean where it actually did mark the bottom, but oftentimes you'll see something like this where we actually do go lower, but only briefly. You know, you go another leg lower and you see volume on this candle that's not as high. It might reach here. That's actually a decent indicator as well that the bottom is in. So this is your true signal for the bottom, but always be aware that no one analysis tool, you can't just use volume by itself and expect to make millions. When the volume spikes high here, it's telling you the bottom's close, but if there's another run, remember this is crypto and that can just be a stop run, running against people's stop losses. So especially if you have another push down and the volume isn't as high, you can deduce from that that momentum is weakening. Because if the volume was super high pushing here and it pushes lower but the volume's going down as well, you say, okay, maybe sellers are getting exhausted here. There's not so much Bitcoin left to sell, and we might be in for a reversal. So that's volume, nice and simple. The next most simple and universally known indicator would be relative strength index, which is also known as RSI. You pull it up on a chart like this. So I'll go to a 5-minute chart. The 1 minute's a little messy, and I'll actually remove the volume indicator for now just so we can see things a little bit more clearly. So what is the RSI? Well, like I said, RSI stands for Relative Strength Index, and it's a measure of the strength of the market of a particular asset. It's a momentum oscillator, and the way it works is it measures the speed, so the velocity, and the change of price movements. So what's important to note with RSI is that it's based upon candle closes. So if I switch to a line graph, this is how the RSI is calculated. If I go back to hollow candles, when you can see down here at the bottom where this RSI is attempting to print a number, so at the very bottom it printed at 24.4. If you look to the right, at the very bottom of this dump, that will have printed upon the candle close. Okay, the RSI cannot print at a level until the candle closes. That means therefore that the wick is irrelevant. During the candle, before this one closed, the RSI would have actually been lower because the wick was down here, but by the time it closed, it had bounced. And so at close, the RSI was 24.4. So if it helps, you can switch to a line chart. This is how our RSI is calculated. We're going to talk about divergences in a moment. And it's important to note that divergences are calculated based upon this line chart, which is off the candle closes and candle opens only. So wicks are irrelevant for RSI. That's what you need to remember. So the RSI oscillates between 0 and 100. You can see here. If I pull this down, you can see that it goes from 0 to 100. All right. Typically, as in this indicator, we consider the RSI to be oversold when it's below 30 and overbought when it's above 70. If you're taking an extremely simplistic view, it means that at 30 you should buy, 30 or below you should buy, 70 or above you should sell. And there is actually a pretty decent, example of that here, where when you went over 70, if you had a sold, you would have been in profit. And when you went below 30, if you had a bought, you would end up back in profit. Now, of course, it's not as simple as that, but that can show you that RSI, as a fairly basic tool, is quite useful, and to be honest, has much more value than some of these complex, overly convoluted indicators that people try to shill to you or try to say is the magic, the magic trick. There is nothing, there is no magic trick in markets. Simplicity is key. Simplicity always wins. And so that's where RSI really comes into its own. So again, I have to mention, it's about the magnitude of a movement. So it's about the speed, the how fast the candle moves, and the difference in price is what determines the strength. So RSI does not account for volume. It's purely based off the price and the movement between that. So candle open, candle close, and the velocity of that movement within the candle open and candle close will give a print on the RSI. You can see here that this is just standard on TradingView that I've loaded up. You can see there's a yellow line. That's a moving average. So moving average is exactly what it says it is. It's an ongoing average of the RSI over a defined period. In this case, it's 14, so that'll be 14 bars. So each time a new candle closes, this line will update, and the line is based upon the previous 14, and it takes the average of those. And so, again, to keep it quite simple, you can use this as a confluence for some trend following, and saying that right now, if we go back to the candle chart so it's a bit easier, you see that right now we're trading below the moving average on RSI. The RSI is dropping and heading towards 30, where we could expect it to potentially bounce. And you can see the price is trending down as well. So if you wanted to go long here, the best way to say would be, well, I'm not going to long on the 5-minute chart until we at least hit 30, or we see the moving average get reclaimed. So if it somehow pumps back up above this, starts to hold there, and price action is favorable, you could potentially take a long. But really, me personally, I avoid any trades that are anywhere between 35 and 65 really. But ideally, the whole point of it is that you're catching extremes. So you don't need to take a long before 30, and you don't need to take a short before 70. Whatever time frame you're trading on, at least wait until it reaches one of those extremes. Right. So that's the relative strength index. The best way to use it is to wait for a divergence. There's two types of divergence that I'm going to talk about, bullish and bearish. There are other divergences known as hidden divergence. If you want to know more about those, you can Google them. Just Google hidden divergence, RSI. I don't personally use them or find them useful. So I'm going to talk about what I do find useful, which is a regular bullish and bearish divergence. What does that mean? What is a divergence? First of all, a divergence is when you see a break in direction between two related assets, charts, indicators, or lines, essentially. Anything that you're comparing, things that are supposed to be correlated, when they decorrelate briefly and head in opposite directions, you can call that a divergence. So very simply, the idea of RSI would state that as the price rises, the RSI would rise. So you can see here, price goes up, RSI goes up. And most of the time we see that. Price goes up, RSI goes up. Price goes down, RSI goes down. Well, what we're looking for, and what's the most profitable way to trade with RSI, is to look for a divergence, meaning where price goes up, but RSI goes down. If RSI goes down, okay? So we'll find an example on the chart here. And again, it's better to use these things at extremes rather than in the middle. So you want to find the divergences around the 30 and around the 70. So let's take a look here. There is an indicator script that can find them automatically for you, but it's good to be, I would not recommend using it right away because you need to be able to spot these things for yourself. Again, trading is all about pattern recognition, so don't be lazy and do the work. So if you're looking for a top, what you're looking for is that price continues to rise, but RSI drops. Okay, so price makes new highs when the RSI drops. So let's see, can we find a top here that meets that criteria? Typically, before you see relatively big moves, you'll see a divergence. Was there one here? Yes, this is one. So you see along here, RSI, although it didn't touch 70, so actually I'm going to find one where it did touch, just to be congruent with what I'm trying to teach. Here's a perfect one. Perfect divergence on the 5-minute. All right, so remember, we're looking at the line chart here. So here we have Bitcoin's price makes a high, and then it makes another high. See here? But the RSI on the first high, it peaked just over 70. By the time we reached the second high, it was down. Very clear divergence. What makes this even more powerful is that Bitcoin continued, as you can drag this, to make another high. If you want, you can just drag from one to the other and see that it's made higher highs on the price chart, but on the RSI chart, it's continued to weaken even further down to here. So that's a really nice divergence. And so you can see from there that momentum is clearly weakening because price keeps going up, but the momentum oscillator is showing weakness. And of course, it leads to a pretty significant downside and a potential for entering a profitable trade. Off the chart there. Right. And when you look at that on the candlestick chart, you see much the same. But just to be clear, here we are. So if you don't like flicking back and forth between line and candles, then just take the candle close. So here was our peak of RSI. Candle close was here. Drag it across to the highest candle close on the other one. Same thing. Essentially, just ignore the wicks. So that's how you spot a divergence. Obviously, bullish divergence is the same thing in reverse. So you're looking for price to make lower lows on a close basis, but the RSI to make higher lows. What I will say at this point is, in crypto, using RSI on any time frame is more reliable for spotting tops. So oversold RSI and bearish divergences are more reliable as a signal than overbought signals and bullish divergences. The reason for that is that crypto is inherently long biased. So traders, crypto speculators, they're typically long biased and they're essentially just afraid to sell and they're greedy. So if you look at when price goes up and you see a bearish divergence on the chart, most people will say, oh no, it's going higher. There's another target above. I should take profit here, but I'm not gonna. I think it's going up. You know the feeling. I'm sure you've had the feeling. But when price goes down, the inverse happens. As price goes down and it starts printing a bullish divergence, people buy in immediately. As soon as it hits 30, they buy because they're taught to buy at 30. As soon as you see a bullish divergence, they buy. And smart money, market makers, whoever you want to call it, they know this and they can counter trade against it. Where you'll see on the downside, you can often see multiple bullish divergences printing even as price continues to drop significantly. So it's not to say you can't use it's not to say you can't use RSI and the bullish divergence don't work. They absolutely do. They're useful. But I find, and the data backs this up, that for spotting tops and bearish divergences, much more reliable. So that's RSI. Next, I want to talk about moving averages. So you have two types of moving average. As I take this off, you've got a simple moving average, or an SMA, which I'll look at here. If you go on TradingView, it's just moving average. And you've got an exponential moving average, or an EMA. So I'll add one of each to the chart. So a simple moving average measures the trend direction over a period of time. And the simple moving average just simply calculates the average of price data. The EMA, the exponential moving average, applies more significance and gives greater weight to data that is more current. Okay? So just to clarify that, and I'll explain why I prefer to use exponential moving average. But the moving average, whether it's SMA or EMA, is calculated by adding up all the recent prices and then dividing them by a specific time period. So, very basic. Let's go to the SMA here, and we're going to put it to 50. We'll keep it the same as the chart's time frame. And we'll make it a different color here, make it yellow, so it stands out. So this line that you're looking at is a calculation, we're on the 5 minute, it's a calculation of the last 50 5-minute candles, all added up together and divided by 50. So all the prices of the previous 50 candles added together divided by 50 gives you the 50 period moving average for that particular time frame. And that's the smooth line you see. The purpose of a moving average in terms of how traders trade is that it just gives a visual for what the fair price, in air quotes, could be for that asset. Of course, there's no such thing as fair price, really. It varies based upon people's opinions. But the market is just a collection of opinions, and moving average is one useful way of measuring those opinions. Now, the exponential moving average, I'll make this one green, and I'll also move it to 50 just to be able to show you the difference. So here we see the exponential moving average also at 50. You might wonder, why is there a difference? Well, just like I said a minute ago, the exponential moving average places more significance on the more recent candles. I'm not going to get into the calculation of exactly how it does that, but it is not a calculation of the 50 most recent candles divided by 50. It's not, you don't total all the 50 candles and divide them by 50. It gives more weight. So let's say the most recent 10 candles will be given more weight in this equation than the first 10 out of the 50. Okay? Why do they do that? Because the theory is that it gives a more accurate, up-to-date, in the moment moving average. So as I'm sure you could tell, or I'm hoping you could tell, an exponential moving average is more relevant to a shorter term trader or somebody who wants to execute with more recent data or wants to give more weight to the more recent data. It doesn't have to be always short term. I've just removed the SMA and I've left the EMA. If we go to a daily chart, you'll see it's still there. It's still just as relevant. So what's this doing versus the 50-day moving average? In fact, actually, I'll keep the moving average for 50-day on. 50, make it yellow again. All right, so you can see the yellow 50-day simple moving average is just the last 50 days. added up and divided by 50. But the green line is giving more weight to the most recent price action. So the most recent days have more relevance, and you can see that it's slightly higher because of that. Reason being, on this chart, for example, if you're putting more weight on the recent candles, the green should be above the yellow because the yellow is giving more importance to these further back candles, which had a massive drop, meaning the yellow will still be a bit more suppressed. The simple moving average will be a bit lower because it's weighting these as more relevant than the exponential. So with that said, I like to just use EMA if I'm using it because I'm a short-term trader. I believe it's better. It gives you more up-to-date data, or gives you at least more weight on the more recent data. And for the way I trade, I find it useful. I don't go too complex with moving averages. Again, as I preach with all indicators, simplicity is key. So I believe that a 50, if you want to look for a very simple combination, have your 50, 100, and your 200. And people might get confused or wonder why those? Why not 250? Why not 25? Why not? You can use anything. Feel free. Use whatever you want. This one should be 100. Oh no, sorry. It should be 200. One sec. Change one of them to 200. There you have your three moving averages. Do they mean anything? Well, the whole point is people in the market put importance on them. Therefore, yes, they do mean something. Whether they have any mystical, magical power or not is irrelevant. If other people find value in them and enough people agree that they have some type of value, there will be some reaction based upon them. So this moving average, 50, 100, 200, just keep it on your chart and use it on all time frames. When I flick to 15, it automatically updates to the 15. You can see there, we pushed up as high as the 200 EMA today, rejected strongly off it. So obviously it has some validity, doesn't it? And the reason being is that 50, 100, and 200 are the most, universally accepted. And they're typically trend following. So the idea is, look at how long we've been in this downtrend on the 15-minute. We have never once flipped the bands. We haven't flipped them. We cannot be considered bullish again yet. So if price goes up and suddenly the bands are running underneath price, you can consider trend changed and we might trend up for a while. That's basically all they're there for. That's all you need to look at. And so that's the 50, 100, and 200. But there is actually another way I like to use them that is fairly useful for low time frame trend following. And that is 12 and a 20. You got a 12 and a 21. Don't ask me why, because I have no idea. Again, it's just because they're universally accepted. You go 12 and 21, and they're useful for your short-term trend following. You can see often that when they cross, so as this is trending up, orange is above green. Whenever the green and the orange cross, you can see often that we get an explosive move. And then whenever they cross again, we get another explosive move. So you can see here that as they crossed, which is basically indicating that the trend is now flipped from bearish to bullish, we get a pretty strong move. When they crossed, the trend is flipped from bullish to bearish, we got a strong move. Not a signal in and of itself, just by itself, but they're useful. The idea, what you want to look at is if you're looking to go long here, don't go long until the bands have been reclaimed. When it went this far down and it was significantly overextended, you could take potentially a long back to the bands because they're deviated too far. But if you're looking to get into a trend following, you need to wait until the bands have been reclaimed, jump into a long and ride it up. Same with a short. We've now flipped these bands, and I would expect that when we come up here, we probably fail the retest and we go a little bit lower until we reaccumulate and the bands can get flipped back to bullish. So that's the EMA as well as the MA, but moving averages in general. And now we'll move on to talk about the volume weighted average price, or the VWAP. All right, next we'll look at the volume weighted average price, or VWAP as it's known. So simply type in VWAP, VWAP, and find it here on TradingView. And I'll remove the moving averages from before. So what you see here is a very simple way of measuring an average price in the market, and this is using volume. So there's two ways. The way I mentioned previously, which is the moving average based upon time and price, and then you have this, which is based on volume. So this line in the middle, focus on the blue line initially. This line in the middle is the average price as dictated by the amount of volume traded in a given time period. In this case, the session. So from the start of the daily session until the current time. Which is why when you zoom out, you'll see that it resets every day. Right? So this one's much better for scalping and for trading. Because also volume is something that's much harder to manipulate than just the time or price. So time is extremely easy to manipulate because essentially things like this can happen where nothing happens for a while, and then at a certain time they can choose to inject liquidity and push price in one direction or the other, which can skew, of course, how the moving averages, how they read and what signals they provide. Volume's harder. You have to physically trade, buy and sell Bitcoin or Ethereum or whatever in order to have the have the VWAP change significantly. And so looking at it from that perspective, it's a useful metric for measuring. And basically, when you're talking about it in terms of trading, you want to wait for price to deviate significantly from the average, which is here, the VWAP, and you want to trade back to that VWAP. So slightly different to the moving average. The VWAP is not always a reliable trend following. So here you can see that we weren't trending, but we were holding it, and which led to a move upwards. But like the EMA that I showed before, where it actually nicely hugs the bands all the way down and all the way up, the VWAP is not. The VWAP is something that you want to wait for a significant deviation from, such as here. So you want to wait for that, and then you want to trade back to the VWAP. So if you can find a trigger, and the VWAP will not be a trigger alone, but if you can find an entry trigger, if you can find a reason to go long down here, your target, one of them, but certainly and always a good first target, is to go for the VWAP itself. As you can see, price developing live here. We significantly deviated below, as you can tell by going outside of the bottom bands. And if you got long anywhere in here, your target would be this level again. So that's the best use for VWAP. You can see that when you load it up as standard on TradingView, you also have multipliers. So they're standard deviations. You can do 1, 2, or 3. So a standard deviation, one standard deviation would say is not a significant deviation. And typically, price obviously will not be able to hug the VWAP perfectly all the time. it has to oscillate, it has to move up and down. So what's it most likely to do? It's most likely to move between these two bands, the 1 standard deviation. When you start to reach the 2 standard deviation, like here or like here, that's when it becomes tradable. And certainly when you hit the 3, it's a rare occurrence and is certainly something you want to be getting involved with if you can get an entry trigger. So that's how you want to look at the volume weighted average price. My personal preference over moving averages for trading, but used in a different way. You want to wait for significant deviations and then trade back to it. You can also do that with moving averages. A lot of people do, and when price deviates below or above the 50 MA, for example, they'll trade in the opposite direction back to it. But I find that volume weighted average price is even stronger for that, because this isn't a number pulled out of thin air. This is the number. So right at the moment, $19,075 is the level at which in today's full session, the most amount of Bitcoin has been traded. That's how it works. So at 19,075, the market has agreed to trade the most number of contracts, the most number of Bitcoin. That's why it has such a strong signal. So that's VWAP. We'll look at Bollinger Bands next. All right, and I'll remove the VWAP and go out to a higher time frame. We'll look on an hourly. We'll load that up. All right, as you may know, or as you may be starting to realize, most of these indicators and tools that are used in the market are essentially just trying to find some type of fair price and then highlighting a deviation either side of it. So Bollinger Bands are a statistical chart that visualizes and helps you view the volatility of the particular asset. The formula and all that, I'm certainly not going to get into it. I don't know that much about it, and I don't care, and neither should you. The point of the Bollinger Bands is that they've become extremely successful, and they're essentially a moving average with standard deviations. So the values can vary, but I believe typically they're a 20-day average, and then you have the standard deviation set to 2. So your Bollinger Bands are essentially just a more visual representation of a specific moving average as chosen by whoever programs it, with some a cloud and the outer bands to let you as a trader know when we're deviated significantly below or above. There's not really much else to say on Bollinger Bands. It's just a personal preference if you want to use them or not. I mean, looking at them here, yeah, like sure. I mean, you can say here, oh look, great, couldn't get outside the bands, traded back in, but then you've here, pretty significant breakdown from them, again here. The thing with Bollinger Bands, and VWAP's the same, moving average is the same. These work best in ranging environments. They do not work in strong trending environments, or in fact, they often break in those environments. Meaning that when the market is going to collapse and it collapses, it's not going to stop because there's a magical upper or lower band on the Bollinger. I'm sure that's obvious to everyone, or it should be obvious to everyone. But yeah, I wouldn't be the biggest fan of them, but some people like to use them, so it was worth covering them. But essentially, it's nothing that much different to a moving average. All right. Final indicator that I'm going to talk about is probably something that you mightn't see as an indicator as such, and it's the Fibonacci retracement. So this is the only one which you don't kind of plug in or add on to your trading view. It's just one of the tools that's on TradingView. So you can see on my toolbar down the bottom, the fib retracement. If I just draw it, you can see, I'm sure everyone recognizes this, the fib retracement. All right. I have mine set to standard colors, no clouds in the background. I just like the levels. I don't see any reason for any of the fancy shit that they have normally. And if I open it up here and take a look at all the different values that I have, you don't have to copy these values at all. You do whatever you want to do. The ones I find most useful are the ones in the middle. So I like to use Fibonacci as a range tool, and I don't actually use it strictly to what you would say the Fibonacci numbers are, because the numbers I prefer to use, and I will actually change the colors here just so we can make it a bit more clear, is the quarter, halfway, midpoint, and then your upper and lower. So they're the ones I like to use. And just for a second, I'll take this off and I'll take off this one. And there's a 70%. All right. These are the ones that I prefer to use. This wouldn't strictly be Fibonacci. It's really just a way of measuring a range. So if you've got a range high, let's say up here, and you have the very bottom of this down here, what I like to look at is the numbers in the middle. So you've got your halfway point between your local high and your local low. And then you've got your 25% and your 75%, which is just essentially a way of looking and showing, visualizing, if you're kind of in an overbought or oversold. So without having to use an RSI or something. If you're in a clearly defined range, so this isn't a range yet because it's actually trending downwards only. But if this were to come up here, and we are suddenly into what you would accept as a range, then the Fibonacci can be very useful as a measuring tool to tell you, don't buy here and don't sell here. Very basic, but a very powerful thing to implement as a trader. If you just look at the chart naked with no idea of a range high or a range low, you don't know where you're buying or selling. It was quite obvious that if this is a range, you shouldn't buy in the bottom part, you shouldn't sell in the top part. Sorry, you shouldn't sell in the bottom part, you shouldn't buy in the top part. Keep that in mind. That's how I use Fibonacci. I rarely ever use it, even though I have them on the chart. I rarely ever use it for extensions, but for people who want to know how that works. Let's say, for example, you have a high and a low. Let's go to a higher time frame. And you could say possibly here, and you could say, all right, from the low to the high here. So from this low to this high. In this downtrend, you can use these as targets. So you can say, all right, this was the low, this was the high. If this breaks, where are my targets? And you can say this would be 1.25, so like a quarter of a deviation. You could say a half, 1.75, 2, 1.618, which is the golden ratio. You can see in this instance, the price actually did extend to the downside almost exactly 2.5 times of that range. So 2.5 SD, you could call it, 2.5 standard deviations below this range, which is quite interesting to see. But you draw enough of these lines on, you'll always find one that fits. This shows you there's at least a little bit of validity to it. The other common use for Fibonacci would be, like I was saying, with this golden ratio. So very common is to do this. You've got a pump, you go from the bottom to the top. As price starts to pull back, you need to find somewhere to buy. So I'm just changing all this back. So when price is dropping, you want to buy. Where do you buy? You might have a level of support, supply and demand, a support or resistance level where you could buy or sell at. But what a lot of people use are these Fibonacci numbers. So you've got a 0.382. It's based on math. They say, okay, well, the first level of support, all else being equal on this up move, the first level of support should be the 0.382. It's your first chance to go long. You then have the halfway point, which I do personally like because a 50% retracement is a decent retracement, and it's not a mystical woo-woo number, it's halfway. Then you have the golden pocket, which is actually 0.618. I have it as 0.62. Same thing. So you have 0.5, 0.62, you have 0.7, you have 0.75. People try and say that the 0.618 is like it's a magic number. It's a law of nature. It has to be respected. But as this example shows very clearly, we got an initial bounce around that level, but it led to nothing. If it doesn't work all the time, it's not a law of nature. I hope that makes sense. The people the proponents of the Fibonacci sequence and of this golden ratio say that they claim it's a law of nature and it's found in all things. And you certainly can see the golden ratio represented in plants and in spirals and in honeycomb, and you can see it throughout nature. But it's not a law that applies to the markets. If it was, price would bounce off the 62 every single time without fail. Of course, that's not the case. What it is a tool that a lot of people put importance in. So if a lot of people put importance in it, it can have significance in both directions. Meaning, if a lot of people think that the 62 is ironclad and you buy it every time, well, it can be easy to get wrecked. Similarly, if enough people agree that it's a good spot where it should bounce from, then it can actually bounce from there. If the consensus of the market is, for example, on this up move, we bounced from here up to here, we come back to 62, and see we went past it. So whoever bought down here, you could see here that it tapped it and there was a wick. So some people were buying this 62 tap, and they got taken out immediately. So in that instance, they got wrecked. The problem with the 62, the Fibonacci, is that it's very prone to confirmation bias. I'm not going to spend all day trying to find one here, but if you look, you don't have to look that far and you'll find one. If you go from the bottom to the top of any pump, there's one. It wouldn't take long. Bottom of the pump, top of the pump, pulls back perfectly to the 62 and bounces. People will look at that and say, obviously they got wrecked after, which is why often it doesn't work. But people will look at that and they will take the times that it works and say, look at this, it's magic. And they'll show you the times it works. And you say, okay, is that every single movement there's ever been in the market? Of course not. You're showing me the one that works and you're showing me the one that you made money on. The fact of the matter is, it's just plain confirmation bias. So don't put too much stock into it. But that's a bit of an overview on Fibonacci itself. It's certainly useful, super useful for range trading when you use the 25, 75, and the 50 and get your range high, your range low, your mid-range, and your upper and lower quarters. Very, very useful in that sense. If you like to use it in the other ones, the 0.382s and the 0.618s, more power to you. It's not for me personally, but it takes many different types of traders to make up a market, so I'm certainly not going to shit on anyone for using it. But overall, as I said at the start, and I want to wrap it up with this, I'm not a big believer in indicators. I don't believe there's any indicator that you absolutely need, but if you want to use some in order, volume is obviously essential. A lot of people don't see it as an indicator, but it is. Volume, RSI, relative strength index, very simple, very useful on all time frames. It's not 100% signal, not 100% accurate, but it's useful in conjunction with price action and market structure, of course. VWAP will be the next one if I'm putting them in order of importance. I think volume weighted average price for a scalper is the next most important, followed by your moving averages, of which I prefer an exponential moving average. And finally, you've got things like your Bollinger bands and other types of bands, which I'm not a fan of. And in that list, I didn't include the Fibonacci as an indicator as such. It's in this indicator lesson, but I wouldn't see it as an indicator in the way that any of the rest of them are, where they overlay on the chart. Fibonacci is a measuring tool, essentially, but best place to put it is in the indicator section. So that covers everything for lesson 5 from module 3, all about indicators. Sorry if you were tuning in to see me proclaim some mystical, magical indicator. But like I say, the best indicator of the market is you, yourself. And the only way you can become better at indicating which way the market's going to go is through repetition, improving your pattern recognition, and actually being in the market trading. So that's the end of module 3. And you can move on now to module 4, which is the final module. But we're finished here now with indicators.